All right. Well, good morning, everyone. For those of you on the East Coast and Central Time Zone, good afternoon, or really on the East Coast. Welcome to the annual meeting for WDIP's Real Estate Opportunities Fund 6. We'll try and run through this presentation, hopefully in around 50 minutes, and then open it up for questions at the end. So with that, let's get started. So today we'll cover a quick update and a refresh on the history of the firm. I will then spend some time discussing the macro climate, and then we'll hand it off to the team to discuss opportunities in the real estate sector, provide a portfolio update on deals we have closed so far in the fund, discuss the current pipeline, deals that are in the pipeline, and we will finish the presentation with a brief discussion on some fund administration items as well as where we are on the capital raising side. Finally, at the end, I'll address questions. So along the way, feel free to ask questions in the chat box, and I'll try to address the questions as they came in. Next slide, please. So this slide provides a timeline snapshot history of the firm. As many of you know, the firm was founded in 2008 and raised its first fund in 2010. In 2018, we were acquired by Walker & Dunlop and then rebranded and finished the succession plan in 2020, as well as launching this fund, which is the first Walker & Dunlop branded fund vehicle. And we'll dive into some more updates on some of the other vehicles that came in on the next slide. So 2021, the momentum has been really strong for us as a company. We continue to expand invest in more and more opportunities. We actually had a record year in 2021 for capital raising and capital deployment. $565 million of capital raised and deployed $425 million. This fund, which is Fund 6, we have $42 million in investor commitments, and we've invested about $32 million. We also have an additional $10 million of capital that we've raised from co-investors for some of the larger deals that we did in this fund vehicle. So really good momentum. We'll talk some more about the fund at the end in terms of just give an update on where we are on the capital raising side in terms of new capital coming into the fund and how much time is left to raise that capital. Additionally, this year we brought in 2 new debt SMA programs. So many of you know we have both a debt and an equity business to our organization. And so the 2 programs, we brought in a $250 million discretionary small balance kind of bridge loan program with 4086, which is an insurance company, for those of you that don't know them. And then we signed a joint venture, which is a non-discretionary joint venture with the 5 largest Korean banks, providing bridge loans for multifamily housing. And then finally, as we continue to grow and expand, we are obviously very cautious on the new sectors that we invest in, but a couple sectors that we felt are aligned with our DNA has been, and really aligned with kind of the macro tailwinds, has been one, kind of converting hospitality to the extent we can find hospitality that is priced right, but converting hospitality into multifamily workforce housing, and then the single family build for rent marketplace as well. Next. So I wanted to kind of show a quick org chart of the organization. So the firm has expanded to nearly 40 people, most of us based in Denver. I'll talk about this on the next slide, but we've added a number of people over the past year, some really key important hires. But Brian Cornell and Marcus, who are on the phone as well, Brian's the portfolio manager for this fund, and Marcus is the CIO for the organization. And as you can see on the far left, Brian and his team are really the ones that are front and center for deploying capital out of this vehicle. And then just a couple other PMs under Marcus. So we've got Ryan Welch and Brittany Goodwin who run our debt programs. Todd Tiller's on the line as well, who runs asset management. Many of you know Todd. He's been a tremendous help as we've continued to kind of evolve the company going forward. And then I'll talk about Brad's background, but we've added some capital raising folks under Brad, and then Peter Shepard continues to kind of run the company's back office as the CFO and COO. So real quick, couple of key and very important hires that have been really tremendous value add for the organization this year. So Marcus Dooley joined in February. He's the CIO. Marcus and I worked together for over 5 years at my prior organization, LEM Capital out of Philadelphia. Marcus has tremendous investment experience up and down the capital stack and across both debt and equity. We're really pleased to have him on board on board. And then Brittany Goodwin joined as a portfolio manager, co-heading the debt investment side of the business in March of this year, and she's really responsible for originating senior bridge and permanent loans. Not entirely relevant for this fund, other than obviously there's a lot of overlap between the sponsors that we have on the debt side and on the equity side. So a lot of cross collaboration, and Brittany has got very tremendous experience over her career in debt investing. Next. So we also, on the fundraising side, we made a couple of key hires this year. Brad Barsley joined us in June. He's running capital markets and fundraising now for the firm. Brad came over from CBRE, where he ran their capital raising efforts, has tremendous experience and very strong network in the institutional investor world. And then Leon Wang joined us in November from Acor, brings a very interesting perspective. He started his career on the investment side and then moved over into the capital raising. So that really understands the nuts and bolts of the investing side of the business very well as a deep knowledge of and a deep kind of Rolodex of contacts in the investor space. Next. Some structural changes that we made to the organization this year. So we really reorganized the entire company after the succession plan was finalized into kind of 3 key verticals. So capital raising, which is being led by Brad. The investment side, Marcus runs that as the CIO. And then Peter took on an additional role of being also the COO. He previously was functioning or really running the company as a CFO. So he's now both the COO and CFO, and so is responsible for a lot of the different aspects of the business, but all kind of in the back office. And we'll talk a little bit later, but there's a number of just overall improvements that we're going to do to the business over the next couple of years as we continue to just become more streamlined and increase the user-friendly nature of how we're interfacing with investors. And then finally, many of you know Ryan Castle. He's taken on a little bit of a different role outside of operations and more into the strategy side of the business. Looking forward into 2022, we will obviously continue to raise Fund 6 and hopefully finish that raise in 2022. Continue deploying capital out of both our equity and our debt vehicles on the fund and SMA and joint venture side. We expect to begin the raise on Fund 7, which will be our first debt fund vehicle. And then some of you are investors in Fund 4, which is our value add equity fund. We are hoping to launch a follow-on vehicle to that fund as well this year, or next year, sorry. And then obviously a number of system and operational improvements that Peter will be spearheading, just the LP portal side, data reporting, et cetera. And then obviously we will hopefully continue to expand both the investment team and the capital raising team as needed. So switching gears just into the kind of macro side of the providing kind of our perspective on the macro, if you will. If we could jump to the next slide, please. As many of you know, the macroeconomic picture remains extremely fickle. today, we're going to focus on kind of two meaningful risks in the broader economy. Number one being COVID and the never-ending variants that continue to be an issue for a sustained recovery. And the second being inflation. It's obviously for a number of months, a lot of economists and the Fed continue to say that inflation was transitory. I think that that's becoming less and less of a reality, and it seems like that we are going to see a fair amount of inflation for the foreseeable future, which obviously is affecting consumer sentiment, which is deteriorating both between the additional COVID strains and then inflation is having a real impact on especially the lower and middle income wage earners across the country. I guess a little bit of a bright spot would be, real GDP is below trend, but clearly there's some upside potential there, which we'll talk about in a couple of slides, on the next slide. And then, a couple other things on the macroeconomic side which impact real estate. So many people are aware of the supply chain issues that exist in the economy or across the broader U.S. And obviously that's really being driven by the above normal consumer durable expenditures. So we'll talk a little bit about that. And then obviously the below normal non-durable spending is potentially an issue for some sectors of real estate, particularly in the retail side of real estate. And then obviously as a result of all the monetary and fiscal policy that's been going on as a result of COVID, housing and commercial property prices are at all-time highs. So investing in this marketplace with these big meaningful risks continues to be a challenge, and we will continue to be disciplined and really pick our spots until we see some potentially dislocation opportunities. Next. So just this slide just really shows kind of a real GDP trend. You can see on the right, where the kind of COVID gap, like we're still, the U.S. real GDP is still below trend really because of COVID. And although, various forms of stimulus have been tremendous at bringing the U.S. economy back, it's still cause for concern, obviously, that we're still below the trend. But at the same time, maybe there's a little bit of a bullish note on that as well, just indicating that there's further upside to, this incredible economic kind of bounce back that we've had as a result of all the policies that have been put in place. And potentially if production gets back to full capacity, maybe that takes some pressure off of some of the pricing increases that we're seeing on the inflationary reality that's starting to settle in a little bit. Next. So these two graphs, the top one really just shows real consumer spending on durable goods and the trend. And then the bottom one is a chart that's showing kind of the ratio of consumer spending, ratio of durable consumer spending to total consumer spending. So really the takeaway from this slide from the two graphs is really just showing the huge uptick in durable consumer spending kind of post-COVID. So COVID hit, durables spending went way down, and then it bounced back in a very, very aggressive manner. And obviously COVID has caused consumer behavior to change dramatically. And, it's really hard to say at this point how long this trend is going to continue and how long it's going to impact the supply chains. What we also know is that COVID obviously also caused a pretty dramatic spike in e-commerce. And between these two, between the increase in durable spending and the increase in e-commerce, which is requiring companies to maintain larger inventories of goods in closer proximity to end users, this is a good sign for industrial, and we'll talk a little bit more about that later. But we track this data because because of the positive implications that it has for industrial, and we continue to be pretty bullish on that sector. Next. So this slide really shows consumer non-durable spending, which is fell off a cliff, obviously, as a result of COVID, with hospitality shut down, a lot of the entertainment venues completely shut down, and you can see that this spending still has not bounced back. And I think the main takeaway for everybody on this is just it's going to continue to be a challenge for real estate that's impacted by non-durable spending, like restaurants, movie theaters, and these are sectors that we continue to be fairly bearish on, and we continue to stay away from as a result. But we are obviously tracking this on an ongoing basis. Next. So this kind of two things on this chart. One is just showing consumer sentiment. That's the blue line, and it's kind of bouncing all over the place. But you can see on the far right, it has started to kind of drop pretty dramatically again. And then the red line is really inflation expectations. And then as you can see, pretty stable over the last, certainly over the last 7 years, but obviously with COVID, it really has started to bounce up in a pretty meaningful way. Obviously, there are many things that will impact the permanence as well as how high inflation actually ultimately goes, and time will tell how big of a problem that this becomes at a macro level. But we're definitely paying attention to it and looking at both the positive and negative impacts potentially of how that impacts real estate. Next. So this chart just shows the blue is single-family housing price index change, and then the red is the commercial price index change. So clearly we can see we're seeing price appreciation in real estate like we've not seen since the great financial crisis, both in housing and in commercial. It does make it challenging to invest and requires us to remain extremely focused on middle market niche opportunities. You'll hear some of that when Brian talks about some of the deals and Todd talks about some of the deals we've done. But obviously price appreciation is not helpful in terms of addressing some of the ongoing affordable housing issues in this country. So I know we talked about industrial, but just seeing where real estate appreciation has gone, we continue to be bullish on housing as a result, and obviously continue to monitor this and also continue to be cautious about just where pricing has gone in general. Next. Wanted to, I guess, switch gears a little bit on the next two slides, just talk a little bit about cap rates. So this slide just shows corporate bonds, corporate kind of high yield and BAA bonds, as well as long-term government bonds, and just showing that trend along with cap rates, which is the top line. Obviously, bond yields as well as cap rates have continued to fall. I mean, really over the past, the entire 20 years that this graph is showing. I mean, there's some spikes that occurred during the great financial crisis, but yields have continued to come down, and we show that just because obviously there's a lot of talk about how inflation could impact the Fed's action on increasing rates, and that may be a reversal on this trend. So just time will tell, I guess, where this goes. But we're keeping an eye on it. Obviously, there are a lot more factors that drive cap rates versus just interest rates. They're not exactly correlated. But still something that's an important aspect of cap rates, and so we want to continue to follow it. Next. Maybe a little bit of good news as it relates to, just our expectations around cap rates, and that is this chart is showing the spread of cap rates over the U.S. 10-year Treasury, and it declined a bit since the beginning of COVID, but as you can see, the spread over the 10-year is still very wide. And that's not the same across all sectors, obviously, but it's still very at an all-time, we're still very, very wide compared to the all-time low in the great financial crisis, kind of 06, 07. So it definitely, we're still continue to be cautious about the potential rate increases and the impacts of inflation pushing rates up, at the same time knowing that there's potentially some room for that spread to narrow before it truly starts to move cap rates in a different direction. So with that, I'm gonna stop here, and I'm gonna hand this off to Marcus to really start to talk about some of the different sectors that we're looking at and where we are the most bullish and the least bullish.
Thank you, Sam. As Sam mentioned, I'm going to give a high-level overview on the primary real estate property sectors, what's happening in the market, and what are we thinking. Next slide. Let's start with multifamily. We believe the multifamily sector will continue to be a strong area to invest. This is why our portfolio construction of Fund 6 is and will continue to be heavily weighted in multifamily along with industrial. Rent growth rose nationally 11% over the past year, which is a historical high, and some markets such as Tampa, Phoenix, and Austin are seeing astonishing rent increases of more than 20%. Rent growth will remain strong as the demand for housing units continues to exceed supply, with a national apartment vacancy rate of 4.5%. Cap rates and thus going-in yields will remain low, in part due to the ability to still buy with positive leverage, which is basically cheap debt, and the ever-growing demand from investors to buy multifamily. We believe that within this space and strategy, single-family build for rent and hotel to multi conversions are excellent tactical plays to invest opportunistically in this lower yield environment. Hitting our returns is predicated on leasing up new or converted units at market rates as opposed to turning a rent roll with large initial rental increases and high trended rents at exit, which is to say, we can build or buy at a favorable basis and not overly rely on future market growth to achieve our targeted risk-adjusted returns. Moving over to industrial, which is the other property sector where our portfolio is and will be heavily weighted, there is no doubt the growth of e-commerce, which is basically buying things online, is the tailwind that continues to make this a compelling sector to invest. E-commerce is forcing companies to maintain larger inventories of goods in closer proximity to end users, while COVID and rising demand for durables have disrupted supply chains. The complex adjustment of supply chains is slowly underway with the goal of flexibility and less emphasis on just-in-time material supply. We expect acceleration of in-process trends such as the modernization of logistic hubs, emphasis on last-mile distribution, and onshoring of some manufacturing will bode well for the industrial sector. Major markets across the country have seen record jumps in tenant demand that some metros can barely accommodate. As a result, the fastest accelerations in leasing are being recorded in smaller markets with open land for development that typically catch spillover demand from nearby population centers where developers can't build fast enough. New supply is coming, but raw material availability is extending development timelines, and overbuilding is not yet impacting many markets today. We believe there is tremendous opportunity in unlocking value in last-mile industrial repositioning and new development of modern distribution and warehouse space. Next slide. Retail. So what's going on in retail? Well, because of the fiscal support provided by the U.S. government throughout the pandemic and the tightening labor market, which has led to strong wage growth, consumers have trillions of extra dollars. Consumers with more funds at their disposal have pushed retail sales to record levels. Underpinning the strong retail environment has been a return to stores by many consumers as vaccination rates have grown and operations have normalized. Shopper foot traffic has returned to pre-pandemic levels at many open-air and lifestyle centers. In addition, the number of retailers filing for bankruptcy has declined to a 5-year low, while openings are currently on pace to exceed closures for the first time since 2016. Retail is not monolithic. Performance varies by retail category. Retail, especially neighborhood centers, in our view, does not necessarily get enough respect from investors, especially those who may be overly influenced by the COVID experience. Grocery-anchored shopping centers have proven to be resilient during COVID, and it is well known that malls are dying. Malls represent only 8% of the entire retail inventory and are institutionally owned. By contrast, neighborhood and community shopping centers have highly fragmented ownership and well exceed the inventory of malls. Leasing activity continues to be dominated by discounters, grocers, and off-price apparel retailers. However, the reorientation of retailer locations and footprints toward a more efficient model continues to create winners and users in performance based upon geography, box size, and shopping center type. Site selection is even more critical, pushing many national retailers out of secondary and tertiary corridors with low growth prospects. While certain retail is actually performing phenomenally well, we remain cautious in our search for opportunistic opportunities. Now we're going to talk about hospitality. For hospitality, it was anticipated that as a result of COVID, there would be a flood of distressed opportunities in this sector, which has been the hardest hit, with demand basically touching a nadir of zero. The expected flood of impaired sales, however, has not happened, which can be attributable to lenders being willing and able to work with borrowers with restructures and forbearances, and government support with programs like the Paycheck Protection Program or PPP loans. The U.S. hotel industry continues its bifurcated recovery. Whereas high-end hotels and resorts benefited from pent-up leisure demand, downtown locations are still suffering from the lack of sustained corporate and group demand. The continued struggle with the Delta variant, the impending threat of the Omicron variant, and the possibility of plateauing vaccination rates may continue to hinder return to office plans for major corporations, which could have a lingering impact on corporate demand well into 2022 for hospitality. The expectation is, however, that weekend occupancies and demand in markets such as Miami and other sun and sand destinations will continue to be healthy. Currently, we're not actively seeking opportunities in the hospitality space. And finally, office. With office, the national office market is showing early signs of recovery, but the sector still has a long way to go before it reaches pre-pandemic levels of performance. Leasing volume improved in the third quarter, and net absorption was positive for the first time since before the pandemic. Additionally, the amount of sublet space on the market fell quarter over quarter after rising since the onset of the pandemic. So leases are getting done, but still the amount of sublet space is still consuming and still remains at near record highs. With more sublet options out there, office users are increasingly turning to sublet leases for their space needs. Nearly 14% of all space leased in the third quarter involved a sublet lease. While office generally is not favored by the masses, we believe there are opportunities to opportunistically invest in office despite much of the uncertainty around what will be the new office work paradigm as a result of the COVID effect. Valuing office property that is not stabilized with long-term leases can be challenging, and work at home and fear of COVID are exacting a cost on the sector, the extent of which is still unknown. But with all that being said, we selectively look for and can find opportunistic office investment opportunities where we can bring in more institutionalized ownership, management, and leasing with a plan to modernize and reposition the property as something uniquely special in the market and has real demand. We make sure our underwriting has very conservative lease-up assumptions and that we are in a market and submarket with high population and job growth, proven tenant demand, and positive net absorption, including sublet space. And with that now, I'm going to hand it over to Todd Tisler, our head of asset management, who will give you an update on the portfolio.
Good morning, everybody, and thank you again for taking time with us today. We really appreciate it. I want to give you an update on our existing portfolio for Fund 6. If you could hit the next slide, please. The first Fund 6 investment was a hospitality to multifamily conversion facility strategy with a strong repeat sponsor. The theory was to buy Generation 1 and Generation 2 residence inns in solid multifamily markets and convert them to multifamily use. These investments fit perfectly with the comments that Sam and Marcus made earlier. This allows the fund to purchase the assets at a hospitality basis and exit at a multifamily basis. Dislocation between the two creates significant value for the fund. The first of the acquisitions was in January of 21, and it was a 96-unit property in Hunt Valley, Maryland, which is just outside of Baltimore. The property received its full entitlements in June of this year and has been undergoing conversion. This is actually faster than what we'd originally underwritten from a timeline perspective. They've done very well. To date, 45% of the units have been converted from hospitality to multifamily, and 75 of those units are currently occupied. Next slide, please. The second acquisition in the conversion facility is a Generation 2 residence inn in Pittsburgh, Pennsylvania. This asset's located just south of the airport in a very heavy residential and office dense area of the city. Property is 155 units and closed in October of this year. We've just started renovations and they're underway. Really excited about this one as well. Next slide, please. This is an industrial property in Pennsauken, New Jersey, which is just in the Philadelphia MSA. This project was acquired 3 weeks ago through a Chapter 7 bankruptcy sale. We were the high bid on this one with a sponsor that we've done numerous acquisitions with in the past and been very successful with. The sponsor is really active in this market, and this property represents 480,000 square feet of industrial space in a 95% occupied market. We were able to acquire this asset at approximately 50% to replacement cost. The business plan in this is to clean up the property and make it a multi-tenant industrial property. It was originally a single-tenant aluminum foundry. And the next slide, please. And our most recent acquisition is the Front Range Industrial. This is actually another industrial asset. And this is a development strategy within the Denver MSA. This property is located north of Denver on I-25, right between Denver and Fort Collins. This is a 2-building development totaling approximately 206,000 square feet on 36.7 acres with I-25 frontage and access to both on and off ramps going both north and south. There's been considerable leasing interest, and we believe this project will be strongly pre-leased prior to groundbreaking. As an added benefit, there's a right of first offer on an adjacent 70 acres of additional land, for potential further developments at our discretion. With everything going on in the industrial markets, as Sam and Marcus have already touched on, this is a really great and opportunistic play, and we're very excited about it as well. I'm going to go ahead and turn it over to Brian Cornell to walk through the pipeline.
Thank you very much, Todd, and good afternoon or good morning, everyone, depending on where you are. I'm Brian Cornell. I'm a managing director here at WDIP, and I lead our 8-member acquisitions team within the WDIP equity platform. Next slide, please. As Todd mentioned, we've closed 4 investments so far in 2021, totaling $32 million in total equity commitments and $22 million of Fund 6 equity commitments. As we look ahead over the next few months at our sourcing pipeline, there are 4 additional Fund 6 investments either under contract and scheduled for imminent closing or in the LOI negotiation stage. I'd like to take a moment to quickly highlight 2 of those deals that we have under contract that are slated for a year-end close. Next slide, please. Noblesville Industrial is a 314,000 square foot shovel-ready industrial development opportunity in one of the more affluent and high-growth pockets of greater Indianapolis. Similar to Denver, in that part of our investment strategy on the industrial side is to find opportunities in that middle market space, specifically within high growth secondary markets where we can really find pricing power and stay below the radar of some of the more institutional competition that really drives up pricing. So in this example, it's an opportunity we sourced off market through a relationship that was introduced to us through our Walker and Dunlop broker network out of Columbus. The particular local developer had a longtime equity partner that was no longer providing equity for future projects. We were able to step in with him. He has over 40 years of experience, specifically in Indianapolis. And overall, the investment really just checks a lot of boxes for us. I mentioned off market, very strong land basis. The developer essentially contributed the project at his original cost, even though he acquired the site, entitled and rough graded it over the last several years. I mentioned the experience of the local development partner. We always try and partner with local sponsors who really know what they're doing within a specific micro market and have a proven track record of success. It's well located right off of the main thoroughfare. It's in the fastest growing county in Indiana. It's experienced 25% population growth in the last 9 years. Median income's just under $100,000. And I mentioned the attractive yield metrics by playing in that middle market space. So we're underwriting this to roughly a 6.25 untrended yield, which is easily 150 basis points above where similar product is trading in the Indianapolis market today. Next slide, please. Okay, another part of our overall fund strategy is to selectively pursue non-multifamily or industrial properties that have truly unique buying opportunities and what we deem to be outlier risk reward characteristics. And I think this Charleston office opportunity is a good example of that. We're partnering with a Charlotte-based operator that this is their bread and butter. They specialize in office repositionings in the Carolinas, all off market. They've been tracking this particular vacant project in Charleston for over 12 months. They were touring the market and they saw a rundown for lease sign with an Omaha, Nebraska phone number on it. And through that started a dialogue with the owner, out of town family in Nebraska that bought into this through an exchange. They're capital constrained. They were trying to lease and manage this by themselves from Nebraska. And simply they're unequipped to execute an effective renovation and leasing plan. So eventually they capitulated to our sponsor and agreed to trade at a distressed price of $70 a square foot. We really liked the basis, obviously like the Charleston growth dynamics, but I think the real appeal of this opportunity is the immediate value creation available from a full repositioning with an experienced sponsor and leasing campaign in a highly visible North Charleston location and a really tight office submarket, seeing significant corporate investment from the likes of Boeing, SAIC, Mercedes, Volvo's electric car operations, the Port Authority, Jamestown's redevelopment of the North Charleston Navy Yards, et cetera. Notably, Amazon's actually leasing a portion of excess parking at the property, and they are among the real prospects for the office space once we've renovated it to Class A standards and demonstrated institutional ownership. Our underwriting on this equates to a stabilized yield just under 9% at a projected exit value 20% below recent sales comps. So this gives us just significant timing, rate, and tenant improvement flexibility to optimize value and realize opportunistic returns under a variety of scenarios. To close, I'd like to reiterate that our current and future pipeline remains laser focused on niche strategies within multifamily and industrial sectors and select off-market opportunistic or distressed deals outside of those sectors that really have those outlier risk-adjusted return profiles I shared earlier. By year-end 2021, our portfolio will consist of 6 investments encompassing industrial developments in high-growth secondary markets, an infill industrial property acquired through a Chapter 11 bankruptcy process, an office acquisition at distressed pricing, and 2 multifamily to hotel conversions with one of our more trusted repeat sponsors. While there are limited signs of distress in the market today and commercial real estate values continue to climb to new highs, I've been really pleased with our team's ability to successfully source true opportunistic deal flow. And I think this is due to a combination of our focusing on the middle market space with less institutional competition, leveraging our access to the internal Walker and Dunlop broker network nationwide. We have offices, I think, in 30 cities now, and really tapping into our direct proprietary deal flow from sponsors and third-party relationships that we've built over the past 15 years in the prior 5 funds. With that, I'd like to turn it over to Peter Shepard, WDIP's Chief Financial Officer.
Excuse me. Thank you, Brian, and welcome everyone. So last but not least, I just want to run through a few administrative items and logistical items for folks. Next slide, please. So first, just to orient everyone in terms of where we are in the life cycle of the fund. We had our first close in January of 2021. We do expect to have another close prior to the end of this year for folks that are contemplating investment. And then pursuant to the terms of the limited partnership agreement, we will have our final close by January of 2023 or sometime earlier. Post final close, the investment period runs for 24 months. And that means that we will potentially be investing out of this fund through January of 2025. Again, that pursuant to the terms of the limited partnership agreement, that may be extended, but we also may exceed that pace. And then finally, the term of the fund runs through January 2028. We are typically investing in 2 to 4 year deals, and so the ultimate wind-up is likely to happen in 2027 to 2028. Next slide, please. So as I mentioned, the investment period runs potentially through January of 2025, but we are already 40% called. That's a testament to the activity of Brian and his team. And folks should be prepared for an additional 10% call prior to the end of this year. That would bring us to 50% overall. And then again, folks should be prepared for us to call the balance of capital through the end of 2022. Again, that potentially may stretch out for several more years, and the variability there is really dependent upon how much additional capital we raise. Distributions, we do make periodic distributions of cash flow. Our sort of benchmark for that is making distributions that amount to at least 1% of capital committed, so folks aren't getting tiny checks. But be aware that these are primarily, or are opportunistic deals, and so oftentimes don't have a ton of cash flow until exit. Next slide, please. So folks should be familiar with our limited partner portal provided by SS&C. I just want to reiterate for folks, please make use of that. Security is a high concern for us. Be wary of communication, particularly capital calls. We only issue capital calls through the secure portal. From a tax perspective, it's year end, and oftentimes we start getting a lot of questions around tax. We will provide all limited partners draft K-1s by the beginning of April. The production of final K-1s are really at the mercy of a lot of the underlying investments, and the timing can be difficult in terms of receiving all the required tax information, but we are typically able to provide final K-1s by July. Also on the tax arena, everyone should have received an Adobe sign document in the email, by email, asking for tax elections. By law, we are required to make tax withholding in various states. Unless you are tax exempt, withholding will be made. But we also provide folks the ability to participate in composite tax returns. For individuals in particular, that is a real convenience. Basically, it allows us to file in various states on your behalf, and in almost every circumstance, eliminate the need for you to file yourself in each of those states. Broadly speaking, any questions with respect to all of these sorts of issues, you can always feel free to reach out to myself or to Claire Williams, who runs our investor relations group. Next slide, please. So finally, just wanted to, Sam alluded to several of the operational improvements that we're making. From a limited partnership perspective, we are embarking on a substantial upgrade of our investor portal. So we'll be able to provide sort of drill down capabilities within for individual limited partners to be able to aggregate information across different funds if you're invested in multiple funds. And then if you could skip to the next slide, also provide drill down capabilities within the portfolio in terms of property mix and returns and the like at the asset level. So with that, we'll hand it back to Sam.
Thank you, Peter. Thanks, everyone. Appreciate everybody taking time, and I'd like to now open it up for questions. I haven't seen any come in through the chat or the Q&A, but if anybody has questions, please go ahead and submit those and we'll address them. So I have one question just on the fund still being open for new investment. The answer is absolutely yes. It's still open for new investment. And just, I would say, reach out to either myself, Peter, or Claire, and we will happily get you any information that you want on the fund and how to invest if you're still interested. Peter, this is really a question for you. So if someone's made multiple investments in the fund, I'm assuming that rolls up into one K1?
Yes, as long as you have invested through the same entity or through the same individual, ultimately the same tax ID number, then you will get one consolidated K1. And that's an important thing. We oftentimes have folks that invest with the first close and then again with the final close. So we remain open to additional investments from existing investors. Sam, we have a question. I don't know if you can see that one about the Alliant transaction.
I can't, but you want to address it, or you want me to address it?
Yeah, there were two questions.
Okay.
Just one was about the Alliant transaction. It came through separately, so I don't think you can see
Okay.
it.
Yeah, so I'll try my best to answer it. The Alliant transaction is a little bit different it's a little bit different business. So that the Alliant organization as a whole is focused on affordable housing. And I don't know if that's fully closed or if we're still in process. Do you know, Peter?
I do not believe it's closed yet.
Yeah, I think we're still in process of closing that transaction, but large organization, very good reputation in the market in the affordable housing space. We do expect to find some synergies there for sure as it relates to us also investing in affordable housing. But their approach is different. Their investor base is different. They're much more tax syndicate kind of strategy in terms of the investor base and how they invest. But to the extent that there's opportunities that overlap, certainly there will be synergies, but obviously more to come on that transaction once it closes and once we're able to really kind of share more information with their organization and vice versa. Do you have the other question, Peter? And then I have another one for you.
There was one other that had been submitted sort of through a separate avenue here, which was CrowdStreet.
Yeah, so on CrowdStreet, we did put the fund up on the CrowdStreet platform early on, and for us, CrowdStreet is another type of investor. We obviously go through a lot of channels to raise capital for the fund, both on the institutional side, family offices. We're always interested in pulling in high net worth individuals, and so obviously the CrowdStreet platform has tremendous access to high net worth individuals, and so we thought that would be a good platform to post the fund on. And there are a lot of synergies between the broader organizations as well. We've a lot of deal flow our capital markets group has shared with CrowdStreet, so good synergies there.
So I see two tax-related questions. I'll address them in reverse order. For one of the questions was, do we usually have enough depreciation to cover ordinary income? And the answer is yes. Most often, particularly in these opportunistic deals, our depreciation results in an operating income loss. And then ultimately, when we sell the property, there's recapture. But we don't typically have a lot of ordinary income generated from these funds. The second question has to do with the state election forms. I'll try to answer that question briefly and not bore everyone with tax, but we sent out a very simple form to all of the limited partners in all of our funds, which basically is, hey, are you tax exempt or not? If you are, we don't have to withhold the state taxes. And if you are not, do you wish to participate in the composite tax returns? There are, unfortunately, every single state has their own rules. And so that's a very simplified view. There is also a text box that says things like where you can put additional information like, yeah, I want to be in composites, but I don't want to be in composites in California or whatever other state. Those forms did go out. It went out by Adobe Sign. If you did not receive them or if you were weary, thought maybe it was phishing and wasn't sure, again, please reach back out. We will make sure that everyone on this call gets a follow-up email with the folks to talk to if they have questions about anything tax-related.
That email actually went out from Luke Solner from Peter's department. So if you're looking to search through your emails for a potential lost email, it would have come from Luke.
Thank you.
Peter, there's a couple more, and I think that are probably maybe better suited for you as well on cost segregation and then just the cost of fundraising.
Okay. So the short answer to unfortunately there's never a short answer on tax. I will say this: we are very well represented by tax counsel. We review all of the tax returns that are done on the individual property level as well as the funds. Cost segregation typically is advantageous for real estate investments. In a fund structure, that is not always the case. And there are exceptions to every rule, but I will just say that it is more simple than, hey, do we pursue cost segregations or not? The answer is really, it depends. I will tell you that we are always focused on making all of our decisions and our tax decisions as tax efficient as possible, and we are typically quite successful at that. But the second question was, what are the costs of fundraising from different sources? Is CrowdStreet one of the lower cost methods? We don't actually pay to CrowdStreet to raise capital on our behalf, nor do we pay, to the extent in our history we have ever engaged capital raisers or agents. Those fees are never passed on to our limited partners. And so CrowdStreet is, as Sam said, an interesting avenue for us. It is strategic in terms of the way we potentially raise money to augment our internal resources over time. But we don't pay for that. Certainly you as LPs don't pay for that. The LPs that invest through CrowdStreet actually pay more fees than just coming to us directly. And that's how CrowdStreet makes their money.
All right. Well, I think that's a wrap on the questions. Again, if anybody has follow-up questions or doesn't feel like we answered the question to your satisfaction, please just feel free to reach out. We're always available. We appreciate and thank you for everybody for joining. We appreciate everybody's support in the fund. And again, if anybody's interested in investing, please feel free to reach out as well. And just thank you to all my colleagues for joining as well.